Can numbers mislead an investor? Is it right to determine the value of a stock by using reference numbers? Industry expert Amrita will share her thoughts with us now.
So anchors are used in boats and ships. So anchoring bias is you want to gauge the value of a particular stock or a particular fund or a particular scheme. You are looking at some reference number. And that reference number is very arbitrary, is very random. It is not driven by fundamentals. So let me explain it by giving you an actual example that German judges with average of 15 years of experience on the bench had to read out a prison sentence for a woman who has been caught for shoplifting. But there is a kahani mein twist, and the twist in the story is that before giving their sentence, they have to roll a pair of dice. The pair of dice has just two numbers on the either side. One is 3 or 9. So they have to roll the pair of dice. After the dice has come to a stop, they look at the number. And after that, the judge is allowed to give the prison sentence to the woman in months. You will be surprised that those judges where the dice roll came out to number 9 gave a sentence which was 8 months. And for those judges where the number came 3, gave a sentence of 5 months. The information is same. Woman caught with shoplifting. But can you believe that this kind of a dice became an anchor? And they actually gave up. How can that 5 months and 8 months, it might look like only 3 months ka difference, but it is a lot for a woman who's getting that particular sentence. But can you believe that information is same, but when there is a reference being given in the form of a dice roll, that actually influenced the judges, and they are all experienced judges' decision. So it can happen to not only well-experienced people, it can happen to anybody. The outcome of a dice roll, 3 or 9, served as anchors for awarding prison sentence. So another example, assume you have bought a stock for 20 rupees. It goes to 50 rupees. It falls down to 30 rupees. You are still thinking it will go to 50 rupees. What if that stock is Kingfisher? What if that stock is some other non-quality stock? So this kind of an anchor is not driven by fundamentals. It is just driven by some number. So many a times we look at price. We look at these kind of returns that a fund has given 200% return. Next year it falls by 20%. You're still anchored to 200%. Now that's not the way to look at it. So when we look at the price first as a reference, not look at fundamentals, stick to our original estimates without welcoming new information, welcome to anchoring bias. So how do you reduce anchoring bias? So anchors are not right. So for example, a fund can give you 200%, next year falls to 25%, next year goes up by 10%. The respectable returns expected from an equity fund is anywhere between 10 to 12% or maximum 15%. If overall it gives you compounded return on in a 5-year, 7-year, 10-year time frame, that's good. But thinking, it will give 200% always, it's not a fair estimate at all. So how can you reduce anchoring bias? Option number 1, accepting that such a bias exists. Option number 2, asking ourselves that is the price estimate driven by fundamentals or by some arbitrary, that is random reference point, by diversifying our investments. What exactly, how can you reduce anchoring bias? Any kind of cognitive bias, all the biases and especially cognitive biases, the moment you know that you are looking at some random number as a base, you are not consuming information in a proper manner, recent dramatic events are affecting your memory, then you are aware of it. And this leads to you being very evolved and mature in your investment decision making. So acceptance of a bias is important, and asking ourselves that whether our price estimates are driven by fundamentals and not by some arbitrary reference points is also very important. So also, I'll ask that is it rational or are being anchored to last year performance figures? So if you are into some bad quality stocks and you still feel that it will go to 500,000 rupees, whatever, it will not go. So there was another company called GameStop, if I'm not mistaken. It's a brick and mortar video conferencing, video games company in the US. And there, the traders of Reddit platform started buying it a lot. The share price went from $3 to $500. Now, $500 is a very high price for this particular company, because the company does not deserve that kind of a pricing. But not only the traders benefited, but it was the retail investors who lost money. They didn't benefit because the share price ultimately tanked. So when you are getting anchored to some side of a price appreciation and think that I'll also get it, that's anchoring bias.
Thanks for your detailed explanation. Are you in search of a personal guide who can remove the stress of handling your finances? Then please feel free to avail our expert consultation. And also, you can attend our webinars to gain investment related insights. Both the consultation and webinar are absolutely free, and you can find the link in the below description. Please like and share, and do subscribe to Holistic Investment.